Hi everyone, welcome to the webinar, the investment webinar. We're going to get right into it because there's quite a lot to get through. I spent most of last night awake going through all the research, all the data on the stocks. I'm going to show you how we do that process so that you can copy the process, and I'll give you the names that have come out at the end of it. We got down from 10,000 down to 37. It's a bit like, you know, UK, US, you've got talent and you get all the people sort of showcasing in front of you and you knock it down from 10,000 to the final 37. And that's the judging process. And it's like any other judging. It's a lot of hard work. There's got to be stringent criteria. And if companies don't meet those criteria, they don't get to handle my pension. They don't get to handle my son's pension either. And that's what we're looking at. That's essentially what investing is. It's 10,000 companies putting forward their CVs to say they should be managing your money. So let's get on with it. And this is an update to my last, a significant update to my last webinar a couple of days ago, because I've got the shortlist now as well. So let's turn on screen share so that you can see everything, and you should be able now to see the screen. Also, what I'd like you to do is there's a poll on the screen. If you can see the poll, that's great. Do fill that in. We're going to do quite a few polls in this so that everybody gets to understand what everybody else is thinking. And also, just let me know you can see and hear me. Type it into the chat box. Get your grey cells working. Close the doors. Turn off the TVs. Don't try and multitask. Grab a pen and paper, and you will want to take photos of the stocks I'm going to put up. So have your camera phone ready as well to do that. And also, yeah, like I said, let me know where you're from. So we've got Barry from Watford. Let's just give a shout out to some of the others who are on here. Everybody who's signed up, thank you very much. We've got over 200 registered. So I am going to, here we go. Blaise, Eric, Gordon, Martin, Carl, Julian, Richard, Derek, Ian, Graham, another Ian, Bob, Nilesh, John, Don, Jeff, John, everyone else, thank you very much for signing up. So let's get on with it as you all sort of make yourselves comfortable and everything else. Welcome, welcome, welcome. If it's your first time, just give me a shout out. Just let me know it's your first time on one of my webinars. Okay, so this is why we're here. You can see it on the screen, and you will almost certainly fit one of those categories. If you don't, put it into the chat box and let me know who I've missed out. Okay, but that's what I keep hearing back from people, especially those of you who filled in the surveys or email me, or on my Telegram, or on my Twitter, or on my LinkedIn, or on my TikTok, or on my Facebook. That's what I keep hearing are the key issues. Now, first things first, none of this is individual advice because I don't know you individually, so it can't be individual advice. And just because I've shortlisted the stocks that I'm going to be picking from for my SIP, my ISA, my son's junior ISA, my wife's SIP, doesn't mean they're suitable for you necessarily, because for all I know, you're a, I don't know, 100-year-old billionaire, or you're a 17-year-old person with no money. Okay, so it's to show you the process and the risk reward profiles, and then help you make your own decisions. The worst thing I am at forecasting is when I'm going to finish that book. So the Financial Times are going to be publishing it. It'll be out shortly, hopefully this year. I just get busy with so many other things. Okay. The other thing I want to get across to you is I do not have a conflict of interest with you. I do not have a retail fund. I do not have a retail long-only fund. I do not have a brokerage. So I'm not trying to get you to trade more. I'm not trying to get you to be invested in the markets. I get no benefit whether you're invested or not invested in the markets. I'm not JP Morgan or Goldman Sachs, where if you invest with me, I get a cut of your fees. None of that, right? We run a hedge fund, a private equity fund. I've been in the investment market for decades. I've written 18 odd books on investing, including Investing Unplugged, with lots of credentials. And you can see the other books over my shoulder, which have been translated into Spanish, German, Mandarin, Polish, Russian as well, and so on. So I've been communicating with the retail market for decades, and this is an extension of that. The institutional side, we have Rothschilds as our bankers, Ernst & Young as our auditors, and Overy as the lawyers. It's a different world, and that's where our offices are, on Brook Street. If you're ever in Brook Street, say hello. Pop in. If I'm in, we'll go for a coffee. This is the agenda for today. I've simplified this agenda to focus on two things: what and why. What should you invest in for retirement pension? Because that's been the biggest question I was asked. And what if there's a recession? I wasn't really asked that, but you should be thinking about that. And why? How do you know what to invest in, what's suitable as well? Isle of Wight, Buckinghamshire, Watford as well. So welcome one and all. Like I said, fill in where you're from and fill in the poll as well. I'm going to close the FTSE poll. Will it close higher by the end of 2023? More than half of you think yes. I'm ending the poll and you should be able to see the results. Not sure, 28% of you. Okay, so more than half think the FTSE will be higher a year from now. That's good. Let's see what you think with the American markets and if you're more bullish or pessimistic on those. So some of the stocks that I've narrowed down, I'm going to give you the list in a second and I'm going to explain to you how. So I'm going to talk about what I think is suitable for a pension and for retirement. And some people are already retired. Others might be in their 30s and 40s and are just looking at saving for the future. And what's going to go into mine. And these are the characteristics of some of the companies that I'm going to explain to you. Okay, I found a biotechnology company which focuses on discovery, development, and commercialization of medicines that addresses critical needs for people impacted by rare autoimmune and severe inflammatory diseases. I found another company which provides wireless fabric, including intelligent radios, smart antenna, and cloud-based network management services. Well, we know the cloud's going to be huge. More importantly, they service business and governments throughout North America, Europe, Middle East, Caribbean, Latin America, Asia Pacific. In other words, geographic diversification and customer diversification. That's good. A separate company, which I'm going to disclose in a moment, which made my cut of 37 out of 10,000. And it wasn't based on their descriptions. It was because very often when we did the research, I'll explain to you what you should look for in companies. We'd find things like this. They're generating 100% cash return on the capital they invest and growing revenues at 40% per annum and forecast to grow another 50% next year. But the share price is 45% below its fair value based on discount cash flow. It was that, well, wait a minute, Alpesh, how the hell do we find all that out? And how can we do that for 10,000 companies? You can't even do that in one night. So I'll show you how you should make that process a lot quicker so that you can get to those kinds of companies. The third company I'm going to disclose to you in my list of 37 out of 10,000 that I've compressed is a company which develops and delivers diagnostic information services such as routine testing, non-routine advanced clinical tests as well. They work with a network of laboratories, patient service centers, and health and wellness professionals. Well, we know how important healthcare is going to be. And I'm going to show you from the big banks and the reports from them, like JP Morgan, Goldman Sachs, and all those, that healthcare is a key focus of 2023, where they're advising their wealthiest clients to get into. And again, what we found from these companies was typical statements like this from our analysis, with a forecasted annual earnings growth rate of, say, 37%, but undervalued by 60% based on discount cash flow. So that's the kinds of stuff we were looking for. That low valuations, high growth, good dividend yields. And we took a pool of 10,000 companies. That's all the companies listed in America, all the companies listed in the United Kingdom, all the global companies also listed in the US. That's 10,000 in total. And then compressed them into which ones had those kind of low valuations, which ones had good growth, past and projected, which had good dividend yields, good upward momentum and trajectory. I'm going to teach you all of that and give you the names of the companies. So you're going to learn how to fish, and you're going to be given the fish as well as part of it. Just part of that exercise, some of the companies that I'm going to mention are also, here's another one, a company which distributes agricultural equipment. Well, demand for food's not going to decrease, not with growing population. And replacement parts worldwide, combines for harvesting crops such as corn, wheat, sweet soybeans, rice, and self-propelled vehicles as well, and crop protection, chemicals, fertilizers as well. We know that's going to be a huge area. I've got a separate company which manufactures and distributes components, building products and materials for a recreational vehicle, marine, manufactured housing. Well, we know housing's going to continue in demand, industrial markets throughout US, China, and Canada. That's interesting. The world's two largest markets covered. So you can see I'm up for the geographical distribution as well. And finally, another company, a separate company, which engages in acquisition, leasing, releasing, sale of various types of intermodal containers and chassis for shipping lines, freight forwarding companies, manufacturers, operates in Asia, Europe, Americas. Well, you've got a global company, and that demand for moving freight around doesn't look to be declining, despite the fact that growth is going to slow. But if they're companies which are projected to continue growing and are undervalued, then we're protected. So that's the broad type of analysis. Now, I don't expect you to go through all of these numbers, and this is just one example, and do it. it's our job to do that for you, and I'm going to teach you how we do it. Before we get into all of that, I want to share with you some of the analysis at the sort of helicopter view, the top view of all the major banks, and I'll give you all those research reports as well. Okay, I went through all the major banks and their outlook. So, Goldman's, Morgan Stanley, Citi, Bank of America, and to basically work out what would catch my eye. These were the top factors. I won't go through all of these bullet points. What they all had in common and what they seem to be advising their wealthiest clients was they're overweight the US in equities, underweight the UK. You might think, well, they're all wrong. Should do the opposite, Alpesh. You might be right. They're scaling back on the big mega cap companies and holding a bit more medium and smaller cap companies for 2023. And some of the picks I've got reflects that. Energy, healthcare, and financials, they're particularly favorable on. Well, that's their business, but I'm saying I don't disagree with them. And you'll see in the companies that I'm mentioning, there's a lot of that as well. They're not worried about the recession because there's very few homes in the UK and US which are in negative equity. And so that's not an issue they're concerned about. And they're really going for quality companies this year. In other words, they're filtering, not just for growth, not just for momentum, but are the companies profitable? Are the earnings likely to continue going forward? Are they geographically dispersed and therefore diversified? And so if they lose earnings in one area, they'll be able to get it elsewhere. More broadly, yes, everyone seems to agree there's going to be a recession in the US, in the UK. It'll probably be shallow in the US, probably a bit deeper in the UK, but they do think inflation will come under control this year and really probably around midway across of the year. So they expect the markets to fall about another 10% before they stabilize and then rise for the rest of the year. Well, we don't care about the big picture. What we care about is how we're going to make money out of all of that, okay? And that's what we're going to talk about. By the way, all of them say be fully invested. Now, this is where I disagree with them. I think they're disingenuous. On the one hand, on page 53 of their reports, and I'll give you access to all the reports for free so you can check my homework. I'll give you that link in the webinar as well. What they've said is, we think the market's going to drop another 10%. Actually, all of them agree on that. Some of them, like JP Morgan, are a bit more pessimistic. Anyway, then they're saying be fully invested. Well, I think that's where they've got a conflict of interest with you, and so have the brokers and so have the fund managers. Because obviously they want you to be fully invested because they want to take your money now before somebody else grabs it. And if they don't say be fully invested, they know somebody else will and they'll take the money. I actually, I'm going to show you why I don't think you should be fully invested yet. I mean, last year I ended up holding about 80% of my SIP and ISA was in cash. And you might say, well, why didn't you put it into the energy stocks that you got into in May? Well, I still wasn't confident enough to put all of the money into just those energy stocks and so on. And I still think I'd rather be a bit cautious and risk averse. So I'm going to give you a little flowchart of how we decide what to do with our money as well. And that flowchart I'll come to in a second. I call it the what should I do, Alpesh flowchart. You can see it here, and I'll come to it and go through it in more detail. But I think it's a very good way. A flowchart's always a good way of making decisions because it stops you, first of all, having to rethink the same thing over and over again, and it simplifies and clarifies everything. Okay, now let's go to that poll before we go into the Morgan Stanley report. Will the Dow be up by the end of 2023? Yes, said 60% of you. Yes, said 60% of you. Interesting that you're more optimistic on the US than the UK, but not by much, not by much. So you're all risk neutral to risk loving, I suspect. Let's reset that poll and let's just have a look at just what you're coming into the markets with as well. Now, as I said, all of these reports I'll give you access to. What I actually want to go through is this little bottom line here that Morgan Stanley said on, they have a 100-page report and they come up with an interesting line, very similar to the kinds of stuff we're going to be looking at. We believe it'll be a particularly good time for compounders. What they mean by compounders is companies which have undervaluation, are growing, have dividends, are profitable, have got good, strong momentum, are geographically diversified, in other words, quality earnings as well, and which are resilient to market falls throughout different cycles. Well, actually, that's what I do anyway. And the interesting thing about Morgan Stanley and all those other reports is they hardly mention, any of them hardly mention a single stock. So what they're saying is, we're not going to give you the names. We're just going to talk in generalities, and hopefully you'll become a client. I'm actually going to give you the names, okay, of the ones which meet the criteria that they're talking about, but not just them. I'm going to show you the billionaires, and more importantly, my own process anyway, and teach you how to do it yourself, to empower people how to manage their own money. Because as I said, there's a lot of you on here who are, they're in two categories. You're annoyed with your IFAs and your brokers and fund managers who let you down, and or you're approaching pension retirement. You just want to manage your own capital, or at least have the knowledge to ask the right questions and make sure the companies that they've put you in through the funds, because they don't know what the funds own, and we can look in, we can x-ray those funds and see what do those funds own, is to make sure you know that they fit into that risk profile. And as you all know, one of the things that I'll take you through in this, the process through which I'm going to teach you to do that, as well as give you my shortlist name of 37 out of the 10,000 odd, as you know, it is this. I will go through all 10,000. I didn't go through all 10,000 last night. Those were narrowed by my team to the top 100. Then I had to go through the 100 individually to narrow that down to 37 based on, well, that's the added value bit that I provide. You know, with that, all tasks in life, you start off with the automation and let the robots do as much as they can based on valuation, growth, dividend yields, cash flow, and we'll go through all of this and why you need to tick as many boxes as possible and filter as much as possible to reduce as much risk of gambling in the market, so that the more boxes that are ticked in terms of value, growth, income, cash flow, all of those things, the less likely you're going to pick a company which isn't resilient. You want resilient companies which, if the markets fall, they don't fall as far, and if the market rises, should leap ahead because they're so good. Okay, and ideally they just keep going up in every environment, but those are few and far between. So I'm going to show you and teach you all of that process so that you can do it easily and quickly, and then write down to get from the 100 down to the 37 was the bit of magic that my job's to sprinkle, which comes with a bit of experience, you know, and reading the mood music as well of what's happening in the world. So first things first, I'm going to answer a couple of questions that I had from viewers of my last webinar. And one of those questions was, well, Alpesh, what about energy? What about housing? What about pharmaceuticals? What's recession proof? So I thought, well, actually, that's a good question. You know, if it's the question you've got, let's go through that. So I did. And I looked at the UK and US markets, and I looked at the valuations, price earnings ratios in the major sectors in the US and the price earnings sectors in the UK. Okay. And as you can see, there are some which worry me, like energy does worry me somewhat, because whilst it's relatively undervalued, it's forecast not to grow, which isn't too much of a surprise. But the fact that it's undervalued will probably make up for the fact that the forecast growth isn't that great and it's already priced in. So I thought, well, wait a minute, which ones would look interesting? Financial started looking interesting, which is a bit of a surprise given the forecast growth, and they're undervalued. So telecom started looking interesting because they're undervalued and forecast to grow a lot. Whereas, of course, if something's not forecast to grow much, like real estate, and yet is overvalued, you might think, I'm a bit worried. So did the same thing with GB market, the UK market. And here, what was more interesting was real estate for the UK. Undervalued, forecasted growth. So let's dive deeper into that, because that was what the question was. And this is the question that I got. And then I deep dove into those, or deep dove into those, and found a bunch of UK office companies which were expected to grow, but were relatively cheap. Now, this is not for my portfolio. Look at this. This is just me answering a question. More risk than I put into my SIP, because often these companies have a lot of debt. They're not well covered by cash flow and poor dividend track record. And these were roughly 20% undervalued. So they were not as undervalued as I need them to be, but there's some names. So to answer that person's question, what about real estate? Well, I don't tend to look at a specific sector for this reason. What happens is, by the time you deep dive into a specific sector and look for the undervalued company with the growth, you're left with few names, and then you look at it and think, actually, I don't want them because there's just too much debt in them and they're not undervalued enough. So sorry, I don't want it in my SIP. But I was just answering that. That's why I look at 10,000 companies and not just a specific sector alone. And once I've got that 10,000 down to 100, then yes, and I'll share the names, as I said in a second, then yes, I might say, well, I've got a bias towards healthcare if any of my companies are in there. Okay, so it's just to give you another answer, a question which I'm sure many of you had, but also I then did that with the US. in financials, I told you financials were interesting. It just so happens there's a group of mortgage REITs. They don't come under property, they come under financials. And those are the names. Again, it's more risk than I'd put in my SIP. My job is not finding necessarily the right companies to put into my pension or into my savings. It's actually keeping out the 99.9% of things which aren't good enough. It's a bit like finding the right person to marry. It's not about finding the right one. It's probably about being able to say no to everybody else who's the wrong one. So 30% undervalued, yeah. But again, big worry. Earnings forecasts were expected to decline. Lots of debt. Not so happy I'd put them in mine. You might want to look at them if you wish. It's entirely up to you, but I'm afraid they don't make the minimum requirements for me. But I'm putting it in there and answering the question that I had from somebody. And yes, it is a sector which is set to grow and is undervalued. But like I said, for the reasons there, a bit more risk than I'd look at. So what do I look at? How do I pick them so that given that I'm so picky and stringent, which I think is the key here. You see, the problem with IFAs is what they'll do, or brokers or fund managers or brokers like Hargreaves Lansdown who just want to sell you funds, is they'll just write a good spin story because they want you to give their money into their funds, and then the fund manager will write another spin story because he's got to do US real estate fund, and they'll shove it in a few of these and think, well, hopefully they'll work out. They can't pick from 10,000 odd stocks. No fund exists which says, oh, we'll just pick from anything, other than in the hedge fund industry. We'll pick from anything and we'll pick the best of the best of the best. The long-only retail market doesn't do that, all right? Just never has. One more question that one of the webinar viewers had that I want to answer, which was this: Alpesh, what about the big fallers? Okay. Oh, Yasmin, I did see your question. I will answer that. I'll answer that probably after the webinar in detail. Yasmin, by the way, has asked me, I have US stocks. I think they were largely technology stocks, you said. Yeah, mostly in tech, which have fallen 50%. Should I sell and start again? I'm going to answer that in more detail outside the webinar rather than just give a yes, no answer during the webinar. And hopefully the webinar will help you answer that as well. But I'll give you a more detailed, bespoke answer at the end of the webinar, as I've done with quite a few people. It's a new thing I've started doing. You might think I'm insane, but I love this stuff, where I've taken time out to email some of you directly from the questions you've posted where I'm not had the chance to do it in the webinar, because I just think it's it deserves more than just a quick answer. The questions, the big fours, and Yasmin, feel free to email me your portfolio and we'll put it through our Excel spreadsheet model and analyze it as well in sort of that kind of format, so it can give you a more detailed answer and send you that information, that data back to you. So your question's answered. Big fallers worth getting into. So somebody asked me that, and the biggest problem I've got with this is, so here's a list of companies which have fallen, 90%, 75, 81%. You might think, oh wow, these must be good ones to get into. They've fallen so much. That's not going to be enough, obviously, in order to pick. And I don't like the way of picking stocks like that, because you might come up with an ASOS. You might say, well, ASOS is fine, Alpesh. What's wrong with it? Look, it's dropped so much, must be a time to get in. And the problem is these big fallers keep falling. And they do keep making it up, then they fall some more, then they go up, then they fall some more. Not for me, not for my SIP and ISA. So just so you understand my mindset, that is not the kind of stuff. Now, if I wanted to do that kind of stuff, I might set aside 10% of my money for the riskier punts. I don't have the time to do all of that, I'm afraid. The risky punts, I just don't have the time for it, right? But if I did, in my younger years I did, but now I just don't, and I don't do it, all right? So I don't do that. I do the stuff which is, because don't forget, the money that I'm investing, the list I'm going to pick from, that's my son's inheritance. That's my wife's SIP, and I don't want either of them pissed off at me. So that's the biggest due diligence criteria threshold I have. It's more stringent than any fund manager who gets paid whether or not you make money, right? That doesn't give them motivation to be right. They're going to get paid their millions no matter what. So I then turned that question around. Well, what if there were medium followers? What if they fell, as Yasmin has said to me, what if they fell, say, 40 to 60%? So I looked at that, and this I just did for fun because it was a viewer question. What about these companies which have fallen by that much and then they've recovered somewhat? So we're not just looking at ones like ASOS which have fallen a lot and then not even recovered, but we're looking at ones, where are we? Where's the thing? Here it is. Then have recovered and are in most cases relatively cheap and producing, this is a measure of cash flow, good cash flow. And again, I've marked in green any of those which are relatively cheap. and you can see some names came up, and I thought, oh, that's interesting. Now, I've not finalized my UK list yet, but these may well get on that UK list. The ones certainly I've marked in green. I finalized my US list, which I'll share with you in a second. I've got 1 or 2 in my UK list. So this might make my UK list, not because of those reasons, because it fell so much and that it recovered, but more because of valuation, cash flow, revenue growth, and so on. So we're going to get down to some names now. And by the way, if you want to access all those research reports, Goldman Sachs, JP Morgan, Morgan Stanley, Credit Suisse, Citi, Wealth, all the rest of it, as well as my analysis of them, I'll give you the link at the end of the webinar. I've put it up on my website. It's completely free for you to download and read those if you wish. Most people don't want to. So let me get to my shortlist and how I got to it. I really want you to understand how. I don't just want to throw some names at you and you go, thanks very much, Alpesh, bye, because that'll disrespect the process. And the process of getting this is really important, that you learn how to do it, because it's your pension, your livelihood that's at stake, okay? And your kids' futures that are at stake. Now, I've been doing this long enough, so I don't want you to think, oh, this is just somebody I've never met before. Who the hell's he on the internet? Well, actually, I had my own show on Bloomberg, my column in the FT, and then I set up the hedge fund and the private equity fund in 2004. I've still been doing news and so on 20 odd years, more than 20 years later. That's my first column in the Financial Times. Take tips from the best in the biz. Diary of an Internet Trader. That's me when I had hair as well. So 5 years, about 250 columns in the FT. Each week I would talk about my investments and so on and so forth. Okay, so just building up the credentials. My biggest worry at the moment is this. Right, that's the S&P 500. That's the US markets, and as goes America, usually so goes the rest of the world. That's my biggest worry. That we have last year went down, up a little bit. People got excited, then went down a bit. Everyone got pessimistic, then went up. Everyone thought it was finished, then went down. Everyone thought, oh, it's not finished. Then it went up. Everyone thought it's finished. Now we're probably here, and most of the banks are saying you're looking at a 10% decline. Okay, before they can even think about a turnaround. The things which will lead to a turnaround in the stock market will be these. First, at least a 10% decline. Interest rates stop being tightened, and they're going to continue being tightened at least for the next 6 months in the US and the UK. Okay, and we get official notification in the US and UK that we are in a recession, and preferably a deep one, deeper than anticipated. Those are the kinds of capitulations which lead then to the stock market to bottom and go up. At the moment, everyone's still too optimistic. Okay, they're all just in denial. They've been fed this cocaine-like drug of loose money for the last 10, 12 years, and they just think, oh no, something will happen. It'll work itself out. Look, we survived COVID and climate change. We'll be all right. We'll be all right. As a species, we're eternally optimistic, and probably more than we should be. So that's what worries me. That makes me risk averse, which is why I've been rather patient in not jumping in to the markets in January. But that's why I say to you, and we're coming to the end of the first week of January, and I'm going to say to you, this is my short list of US stocks, and I'm going to pick from them. Why am I not in a mad rush? Well, because I'm risk averse at the moment. Why am I risk averse? Because what I just showed you on the S&P. Now, I do a weekly update on how I see the US market and the bellwether stocks and whether or not I'm risk averse. And then each week I decide, am I going to buy or not, based on whether I'm risk averse. And if I'm risk averse, I wait a month. Or I might, if there's particular stocks that I like, and I'll show you some of the ones I've just bought, I might average in over the next 3 months. In other words, put a third of the money I wanted to put into that stock this month, a third next month, and a third the month after. When I'm ready, I just go all in, of course, and just buy the stock as you normally would. But I always want them to have volatility under 20%. And the reason is, as Yasmin's learnt, that if you have things with slightly higher volatility, you're a bit screwed as well. Okay. So, by the way, I'll just end that poll there as well. John said he's been in cash since October 2021. Well, that's good, except we've got to make sure you're not in cash too long. Otherwise, you'll miss the upward move. And also, it'll mean that you've underperformed if you'd got into, as we did in some of the 20% of our cash went into energy stocks around May. If you follow me on Telegram and YouTube, you'll know that we got into some of those, and even earlier in the case of, say, McKesson last January, but only 20% of the cash. I'd love to say I put all of it in. I was so brave. And well, no, I'm not that stupid. I mean, you'd think I was insane if I did that. You'd say, well, I'm going to stop listening to this guy who went 100% cash last year into even if it was a narrow sector, it'd be too much risk. But they were good. So this is why I'm still risk averse. So the ones I'm going to pick from on my US list, I'm going to shortlist, and my UK list, I'm not in a mad rush to necessarily. Now, some of you might be more risk neutral and say, I don't mind, Alpesh, I like the names of these stocks, I'm just going to get in. That's up to you. But that's how you decide first. Are you risk neutral or not? And then you look at the individual stocks. And then how do you look at them? I'll explain that. Okay. This is the 1 year performance, by the way. So as John said, sorry, Eric, I'll come to your question in a second. As John said, I'm in cash. Now, I'm not saying that was a bad decision. It was a very good decision. The next best decision, slightly better decision than that, was cash and a bit of healthcare and energy. Because obviously, as we saw, they were rather good. Was that gambling on sectors? No, because the way we did it is when we filtered, we found that the earnings were just strong, so strong that the valuations were becoming cheap because the share prices hadn't caught up with the profit announcements. Because the companies were, obviously, they can't disclose their profits until it's disclosure time. They're not allowed to give inside information. So the share prices just didn't keep up, even though some of the share prices did rise before profits came out because people worked it out. And then obviously aerospace and defense, thanks to Ukraine and Russia and what's happening over there. But that's just last year. What does this mean going forward? This is what we're looking for. We're looking for, this was in my SIP, remains in it. The big problem I've got with what's in my portfolio now is 12 months are up and I keep things for 12 months, and then they've got to, all 10,000 companies have got to reapply again, including the ones which are in the portfolio, to see if they should be in the portfolio. So Eli Lilly, great return. Thank you very much, which is why we weren't 100% in cash. Because there are some which are just good. And this is what I want in 2023. Just so you know what my hurdle rate is, it's 40% per annum. If I don't think it's got a realistic prospect of doing that, then it won't even make it. And obviously they don't all do that. In 2021, 2020, 2019, they over exceeded that. And I'll show you in a second. And that makes up for last year where you only had 20% of your money in investments and they didn't all do 40% or whatever else. Well, Eli Lilly's done about 73%, and that makes up for the ones which did zero or all the cash holdings, because you had a big drag from that. But this is just to give you a mindset, a mental mindset of what I look for and what I think you should be looking for. You've got to set a hurdle rate, a benchmark. And if you don't think it's going to meet that, then you don't get in. You know, it's like your name's not on the list, you're not getting in. So that was there. Now, and again, this was the best, probably the best pick I had for last year, where it had gone from, we'd got in January, and if you follow Telegram, you'll have seen it from 242 to 511. So over 100% return, okay? McKesson. And the problem I've got now I'm faced with is, okay, 12 months are up, it's looking toppy, what do I do? And I'll probably be getting out of it. You might say, no, it gave you 100% return, stay in it. That's not a reason to stay in. The reason to stay in is valuation, revenue growth, valuation, growth, income. And that's a big mistake pension people and private investors make. They say, Alpesh, can you give me some good stocks for 3 to 5 years to hold for the long term? Well, the world moves too fast to hold things for... Oops. The world moves too fast to hold things for more than 12 months. You might end up holding it for 3 years if you reevaluate every year. Does it still meet the value, growth, income? And we'll go through what the criteria are on those so you can filter and screen yourself what they are. But what you don't want to do, a stock's a bit like a fruit. When you're buying it, it's unripe. You know, it's undervalued. By the time a year's up, it should be overripe and ready to fall off the tree. Okay, and then that's it. It's out of your portfolio. You've sucked out all the marrow and all the returns. You got your 100% return. Then get rid of it. Otherwise, what will happen is it'll go sour and drop and make a mess of your portfolio. The only time you still keep hold of it over a year is if you reevaluated all 10,000 stocks again and it was still in the top group. Not because you've got a bias that it was really loyal to me last year, so I'll just stay with it. You know, it's not a spouse. It's not a house. It's not a spouse or a house. There you go. I should put that into a meme somewhere. Okay. And then there were those which didn't quite work out as well as we thought they would. We thought Katerra would make a lot more from, but then it fell back and now we've had to exit and it fell below that support. So when I do my weekly updates, which I broadcast, I say for free on YouTube, I do go through some of these bellwethers and some of the ones we got out of just so you can learn. Okay. So how do we do the process? And then I'll give you the list. So this is the process by which I came up with my US list. So I took the 10,000 stocks. You might find them from social media or articles. We do more than that. We take every single listed company. We're not just going to pick some random, oh, I heard this on the media or in Investors Chronicle or Shares Magazine. No, we're going to go through all 10,000 because, as I said, it is my livelihood, it is my future, it is my son's inheritance at stake. And I'm not going to rely on some lazy journalist somewhere to write up something in the hope that, well, hopefully they crossed all the T's and dotted all the I's. Okay, so it's all 10,000 I have to put in there. I will then filter that for valuation, and I'll show you the criteria in the next slide. Revenue growth. This is how I came to the list for the US and for the UK. Okay, and I'll show you some of the returns we get as a result of this. But it should all make sense to you without me even showing the results. You should be able to see, oh yeah, that makes sense actually, Alpesh. Okay, revenue growth. So we don't just want undervalued companies, but we need companies which are growing and are undervalued. And the reason for that is the research shows that that's the case. And I'll give you the links to all the academic research later. And I've had it published in my books, which are published by the Financial Times and in the newspaper. So it's not just research I've made up, it's research out of universities and so on. And the research has been around for ages. Because I don't want to gamble on, oh, the market likes value stocks, the market likes growth stocks. That's a gamble, and you don't want to gamble with your livelihood and your pension. And you'd be shocked at how many people ruin their lives and their futures because they're actually gambling without realizing it. Okay, so we're going to tick that box, the income box, the cash flow box, and I'll give you the criteria in the next slide. Then, as I said, 12 months and repeat. Now, if it still meets all those criteria, I'll hold it for another 12 months and so on. There are a few companies which I've decided just strategically, which is personal to me, and you can ignore me on this, that I just want to hold even if they don't quite meet all those criteria every year. And for instance, Microsoft, Apple, Amazon are in that criteria. It might answer your question, Yasmin. Okay, it's just strategically, I just want to do it. That's my problem. It's my prerogative. It's my, you know, it's like to you, it's like you might buy Bitcoins. I'm just going to buy it, Alpesh. What's going to do it? Or a Matisse painting, up to you. Okay, but ignore that part. And then it's going to be narrowed down to about 15 to 40 stocks. Again, I can show you the data and the statistics on why it shouldn't be less than that and why you probably don't want more than that. Okay, the average fund has about 100 stocks. It's inefficient, it's costly, and it's costing you, the person who's invested in it, a lot of money because the fund manager's churning those and they've got 100 stocks, which means in probably 80% of those stocks, they've got less than 1% of their capital in there. And why have they got them? Oh, so they've got more stories for the marketing. To say, yes, and we also invested in XYZ, and the company did rather well. It went up 100%. Yeah, but you put 0.1% of your money in there. What's the bloody point? Okay, it's an old fund management industry trick, and it's BS, and they still get away with it. Okay, I'll do my weekly updates. I look at the market and then share that on Telegram and YouTube, as I said, just so everybody else can see through it and see where I'm up to on it. As I said, my requirement is if I don't think I can get realistically a 40% return from that stock over 12 months, then it won't then finally make it. So there's still that final hurdle. And I'll show you images of how we then make that decision, and you should do as well. And if it doesn't make it, it doesn't make it. But because this is quite a bit of work, I've had to simplify, I've had to make it all into a process so that, and yes, I've got staff, but imagine I didn't have staff. Okay, I make it into a process so that it doesn't actually take up too much time, and it doesn't need to. Okay, and what I look at is this. Valuation. We know valuation is important for stock price performance, but we know it's not the only thing that determines stock prices. And out of valuation, you can focus on price earnings ratios if you wish. You can focus on price earnings growth. Now, I will, and from the academic research we've realized it doesn't make sense focusing on every single factor because you're just actually looking at the same thing in different ways. So if you looked at price earnings ratios, even in absolute numbers and kept them below 25, and you might say, well, wait a minute, that's going to leave a lot of companies out. It doesn't matter. It's about the ones in your portfolio, not the ones that you left and missed. You don't have to hit, you're not trying to forecast every company that's going to go up. You're just trying to make sure the ones in your portfolio will give you the returns you need. And by the way, when I say it's 40% realistic, if I average out long-term 20%, I'm happy. But I need to shoot for the 40 to make sure things don't get in, which are definitely going to underperform. Okay, and I'm happy with 20% long-term. In good years like 2020, 2019, 2017, 2016, yes, you do get more than 40, and it makes up for the crappy years like last year when you don't, and you had no chance, and it was about making sure you didn't lose more than all the sums that you had made. Okay, but you're saying is 40% realistic, not because you're guaranteed it, not because there's a bank account, there's no guarantees, but because then you might get the 20, right? Which is what I'm happy with. So price earnings probably even under 25. I'm happy on that. I don't want it more than that. Price earnings growth below 1.1. And if you don't know what that means, it's basically a share price relative to profitability growth. The others, I might, as a tiebreaker, look at discount cash flow, which is what we do in the private equity fund. And that really does help a tiebreaker if two companies look very similar. But we know growth is important, because you could have an undervalued company, which is undervalued because it's rubbish. Equally, you could have a high growth company, which is overvalued and its share price is going to fall. So you need to look at growth. But we know from academic research, we know from our own analysis, growth isn't as important as valuation, but it is important. We'll look for year-on-year sales growth, year-on-year profit growth, which is what earnings means, year-on-year cash flow growth. We know income is important, dividends and profitability. So we do want them dividend paying. And certainly all the bank analysis reports this year said they want companies which are dividend paying. That doesn't mean non-dividend paying companies can't be great. And if a company doesn't pay dividends, but it's got a great valuation and great growth, that'll be fine. It'll still hit high enough a score because there's a scoring mechanism. We'd probably weigh valuation at about 40%, growth at about 20%, as in importance. Out of 100, and in dividend yields is about 10% importance. And then there's things like cash flow, which are incredibly important. I'm going to show you, probably more important than the other, than income or even growth. Momentum, which is just more to do with the trend that we look at, and we don't look for chart patterns and stochastics and the media for this 12-month investment period. And statistics, we want low volatility, but under 20%. Somebody asked me how much, and I'm going to say volatility over what period? 12 months. Okay. Company size now, again, the bank reports have said they're shifting from mega cap to more medium and smaller. So the stock list I'm going to show you in the next slide, it comes up in the next slide. There is some more smaller companies in there. Okay. Then I've got other things which I'm going to show you at what the analysts saying, what are the shareholder correlations. Okay. And what happens when you do that? And I suggest you do that yourself. Okay. That's your approach. It should be. The mistake you'll make is if you think an IFA or a fund manager is doing this, you're wrong. Because you'll have a UK value fund, you'll have a Japanese income fund, which means they're picking from an our gene pool of very few companies, which is why they keep underperforming. And they send you lovely little emails about why they're so clever and, how they went to Cambridge University and have got a degree in this, that, and the other. And in their spare time, they like reading books and being really contemplative, just so you know they're deep and profound and all the rest of it. It is sales, okay? They just need your money so their kids can go to private school. You should be at least keeping an eye over them or managing your own capital by looking at the valuation, growth, income, momentum, statistics. And I've given you the numbers. Okay, there as well. I can go through those again. I obviously put it into a spreadsheet across all 10,000 stocks, but there's websites which will, like Yahoo Finance, for free. You don't need to put it on a website. They'll just do it for you. So let's look at some of the other things that I think you need to tick off. The biggest mistake people make is they don't manage their risks, and so they're gambling by not looking at one of these factors and having it ticked off. And the next biggest mistake they make is they spend all weekend doing it as opposed to just getting the computer to do the hard work for them. So when I went through those 10,000, before I show you the next slide, when I went through those 10,000, okay, I then filtered that down into the top 100, which gets down there, and it has to tick every box for cash flow, which I'll explain why that's important. That's already value, growth, income. I've explained. Momentum, is it up over the last 6 months? How's it doing? How well is it up? Sortino and Alpha, we don't need to worry about at the moment. And volatility, I don't want any pinks, ideally, okay, because that means over 20% volatility. So then what happened is I went through each one of those individual companies to see, okay, they're all pretty much on a tie break now. So I looked at other factors which aren't so important, like discount cash flow, and just their price charts to see, well, is this realistically going to give me 40%? So it's still a work in progress. Out of the 10,000, I got to 37. I've listed some of the names there. I've listed about, a third of the names. Not listed every single one of the 37, because otherwise my clients who get the full list will kill me, and they'll say, if you're giving it all away for free, why are we clients? Okay, and I will be picking for my SIP and ISA out of that list. For the US, I'll come to the UK in a couple more slides, in 2 more slides. But out of the US, I will be picking out of these. And these were the companies which, remember I said earlier on, they had those certain characteristics, the agricultural company, the therapeutics company, and so on. That was out of this. I was describing Horizon, Quest Diagnostics, Cambient Networks, Agco, Triton, and so on. Now, I hadn't heard of most of these companies, but these were the ones who were geographically dispersed, discount cash flow, forecast earnings growth, and so on. Okay, why? Well, there's still more to be done. take Cambion Networks, which I haven't bought yet, and I almost certainly will. Okay, could it realistically give me a 40% return in the next 12 months? So I took the chart and drew what 40% in 12 months looks like. Okay, that's what it looks like. Okay, I tell a lie. My team in India did it yesterday for me, because that's stuff I don't need to do. They can do, and what I need to do is the bit only I can do. Yeah, that looks realistic. Doesn't mean it's going to happen. It's not guaranteed. So there was a company which met value, growth, income, dividends. Can you see how important it is to make sure you tick every box? Otherwise, how do you know that's a company which is low growth? How do you know it's not overvalued? How do you know it's not got poor cash flows? How do you know it's not of any interest to any fund? And I'll show you that in a second as well. Okay, so I've not bought this yet, but almost certainly will. And I might even do it after this webinar, because the US markets will be open by then. And now, UK stock, this is to be finalized. I'll probably finalize this next year. But at the moment, I've managed to shortlist a couple of companies already. For instance, there was a company which provides packaging and automation solutions to healthcare, pharmaceuticals, and food and beverage sectors worldwide. Geographical and sectoral diversification, trading at 48% below our estimate of its fair value based on its valuation, its discount cash flow, and earnings or profits are forecast to grow 58%. So you've got undervalued, forecast to grow, geographically dispersed, okay, in sectors which some should do very well, healthcare and pharmaceuticals. I've got to finalize these. That's the final list that I'm narrowing down. And the reason I've covered it is because I've not finalized the UK one yet. Because last night it was about 5 a.m. and that was like, okay, I need to get to. So I will do that next week and do a webinar for you. So don't worry about that. But there was one. Speaking of healthcare, that's the sort of alert that I'm either I'm not diabetic, but I do monitor just to make sure I don't ever get diabetic. Okay, but there's another one, Hikma Pharmaceuticals, and I've actually named it. I don't know why that spiked. Obviously, I'm too stressed. Another company, so this is Hikma, provides therapeutic areas including anti-infective, cardiovascular, central nervous system, diabetes, oncology, pain management, respiratory, operates out of the UK, US, Middle East, North Africa, Europe, internationally trading 65.7% below estimate of fair value. Earnings are forecast to grow at only 7.8%, but at least they're forecast to grow. Now, some of those forecasts might be optimistic. Reliable dividend of 2.81%. We know that the big banks are going to look for more dividend-paying companies. So that one is trading at a good value compared to peers, Hikma, and it'll be on. That will make my UK shortlist, which I've not finalized. And by the way, you can see from that UK list, which will be finalized, that there's a lot of financials, and I said already that financials look interesting. There's very few tech. There's some basic materials or commodities, and there's healthcare companies which come up a lot as well, viewed consumer discretionaries as well. That's Hikma. Has that got a realistic prospect to give me a 40% return in the next 12 months? And I've had Hikma on and off in the past. Yes, I think it will. Okay? Yes, I think it will. Now, Alex has asked, do I only look at US? What about the UK? I generally only invest in the US. Actually, and since that first column in the Financial Times in 1999, the first paragraph of that column was, I'm selling all my UK stocks and going into US. But don't worry, this is, as you can see, relevant for you, even if you're looking at UK. And I do talk a lot about UK stocks as well. The reason I like US is because I've got 10,000 CVs. I'm not racist when it comes to stock picks and say I only want British C companies and British CVs. I want the best of the best from all around the world. That's why I look at UK, US, and whatever. And of course, last year, that was an advantage because the pound collapsed and therefore the American holdings went up about 20% in valuation just from that at one point, 25% at one point. Okay, so how does this process, how well does it work anyway? When you look at value, growth, income, cash flow, well, in the good times, that's what happened. 54% return in the 12 months to November 2021 from November 2022 to 2020. You might say, well, that's an optimal period. We didn't know it was an optimal period at the time. And you're right, it's an optimal period. That won't have happened in 2022. And it had companies like Crocs in there, Generac, Costamere, Camtech. By the way, Crocs is coming back on the list. Would you believe? Those ugly shoes. Now, that had nothing to do with, oh, but wait a minute, Crocs is not a technology company. Why would you have picked that in 2020? And those who followed me on Telegram and YouTube and all the rest of it would know that it was one of the ones that was selected. Well, it had nothing to do with it. It was the valuation, revenue growth, undervaluation, growth. Why did you only hold it for 12 months? Well, if you look at Crocs, what happened after 12 months, it got so ripe, it had gone up 208%. It was overvalued. That was it. Get out of it. Okay. And then it dropped. Excuse me. And then it dropped. That's why we look at 12 months. And then you've got to reapply for your job, your position in my portfolio. You've got to reapply to my football team. See if you're good enough. Everybody's sacked at the end of 12 months. And if you're still good enough, you get to stay another 12 months. Okay, so that's what happened with that. And now, and here's another misnomer. Did I know it was going to go up 208%? Of course not. Not in my wildest dreams did I think that was going to happen. If I did, I would have sold everything and got a ton of debt, of which I've none, but I would have got a ton of debt and put it all into just Crocs, wouldn't I? Duh. So why don't I know that was going to be the one that goes up 208%? Because I don't have a crystal ball. Even Warren Buffett has a portfolio of about 10 stocks. Why doesn't he put it all into one? Well, because even he can't see that one is the one. In fact, he has put half his money into one company. It's Apple. And he's probably thinking, as of last year, oh, God, thank God we get revenues from our insurance premium. Okay, so that's two important things I want you to know. I didn't know they were going to go up that much. Nothing that I'm saying is going to guarantee these companies to go up either 40% or, hopefully 100%. What happens is when we pick those 15 to 20 or even 40 stocks, some will do this and go up 200%. And that'll help raise our average to a whopping 54% in a good year. In a good year, I don't think 2023 will be 54% return. I can tell, I'll guarantee you we won't get that. I'll be very happy if I get 20% this year. I'll be very happy if I get 20% this year, okay? And I think it's probably possible with what we're doing. Why am I looking at aiming for 40 and looking to get 20? This is the reason why. I think it's really important if you're looking at retirement, pensions, and so on, that you really get an understanding of this part as well. Let's say you're planning to invest over 10 years. And let's say with my help and what I've just taught you and a bit of the names, so I teach you how to fish and show you the fish and how it should be, a bit like a school teacher doing the maths problems for you so you get more proficient with it. Let's say you get 20% per annum. Some years you'll get more, some years you'll get a lot less. Okay, I know that, you know that. Nothing extravagant, but nothing overly pessimistic. And the big banks are forecasting about a 10% per annum from the equity markets because of the recent falls for the next decade, roughly. So we're doing, we're getting a bit of tailwind behind us anyway. Let's say you've got 100K in your SIP or ISA, which is not a lot for some. It's loads for others. So you plan to add 1,500 each month to your portfolio. Well, you'll have $1 million over 10 years. My job for my family is to convert every 100K that we have into $1 million over 10 years. Well, hopefully sooner. But, if it happens over 10 years, that's fine. That's the projection. What does that look like? It looks like this. That's the capital you've put in, and that's the projection over 10 years. Now, why does nobody ever bother doing it? Well, they don't bother doing it because in the first three, everyone goes, you should invest in the long term because of compounding, blah, 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 blah. But they don't understand the psychology of why people don't bother doing it. They don't bother doing it because for the first 3 years, you're not doing as many holidays you could have done if you blew that money, or have as many Ferraris as you might have if you blew the money. No, because the real benefit actually comes in years 8, 9, and 10. And the human brain, for most people, can't conceive that. That's $100,000 a year you're making for doing nothing by then. In the first year, you're getting nothing, okay, pretty much on your investments. By year 9 and 10, you're getting about $100,000 income. We can't think 9, 10 years ahead because we think, oh, that'll never happen. We'll never get to that age. I'll perennially be 21 or whatever we think. Psychology. But this is the reason why we need to be doing it. Let's assume you've only got 10K because you're in your 20s or 30s. And I've got some clients who they've got less money, but they know because they're in their 20s and 30s. Alpesh, I'm going to build it up, but I want to learn now. I want to make sure that I learn for the future when I've got more money, because success is opportunity meeting preparation. So I want to be prepared now so the opportunity when I get more money, at least I'll be educated. Okay, this is what your return will look like. And that's just starting with 10K. That's my son's junior ISA because they're only allowed about 12K in that each year. That's his junior ISA and he's turning 5 next month. That's where he is. And you might think, well, that was a waste of time because look, he's barely been above that. Okay, he's doing a bit better than 20% because the last 4 years, as you know, other than last year, have been rather good. Okay, so yeah, but the point is the little bugger in 15 years will be getting about 100 grand a year for me having to do nothing. That should be in pounds, obviously not dollars because he's British. He'll be getting £100,000 a year for me doing nothing. So he won't be bothering me. I might be bothering him actually and saying, hey son, let's go blow it in Vegas. But the point is, I mean, most of you know this, but keep the eye on the price. Now, these were ones I bought in December. I had a great question from a brother-in-law of mine who works at Deutsche Bank. He said, okay, you bought these in December. Would you buy them in January? And I said, no. If I buy something in December, I'm holding it for 12 months. Okay. If it doesn't meet my criteria in January, and this is in my SIP and my son's junior ISA as well. If it doesn't meet my criteria in January, it doesn't mean I trade the investment and get out. I still hold it for 12 months. We're not trading our investments. Important point. Okay. Really important point. Hope you got that. So then people don't say, well, would you buy those now? And I'd say, no, I'm telling you what's in my portfolio because I told you I would. The ones I'd buy now are the ones from the list I just showed you earlier, the short list, and we'll go through that again in a second, okay, as well. So, sometimes people go, and I'll show you Warren Buffett's portfolio in a second, and Bill Gates and George Soros's. Just because he holds Coca-Cola from 1955 doesn't mean you buy it today. And that's another important point. It's important for you to understand, okay, that part of it as well in that. These are just some of the clients who've paid me for my services, and Barclay's been kind enough to do my book launches. I have discussed this stuff in my various books over the years, so it's nothing new, and it's been very useful for me because it's meant I've been able to do that for my government and my country as well, and explain what I do to people who are in the news at the moment rather a lot. Do the right sums, maximize your return. So let's look at some of those other bits. So bits that I've talked about for years in the Financial Times as well. People have asked me, one of the questions is, when do you sell? And then we'll go through the other criteria. What are in the billionaire portfolios? What else is in my portfolios? What else do I like? And so on. When to sell? 12 months revalue, I've already told you. Or if in that time it drops 25% from the highest point it's been since I bought it. Now, you can tweak that. You might say if it drops 10%, I'll get out. I think that's too tight, but anyway. Okay, you can tweak it. Or you might say 25% from entry and you'll get out. But you can tweak that. I don't have a strong feeling on that. All right. Now, the reason I need you to be in charge of all of this for yourself, one of the key reasons is this. This is from a typical investment trust. That's a typical investment trust one of my clients had. And I said to him, send me your investment trust papers. We'll look through what you own. And on page 36, we found this. And I said to him, you do realize that for every £10,000 you're giving them, you're going to pay them 10% in costs after 5 years. 10% you're going to pay them in cost. He didn't realize that was the case. My point to him was, you can be better than a fund manager. I want to also instill in you the confidence. You can learn this stuff. It's not rocket science. And I'm telling you, as somebody in every profession wants to say, oh, no, it's so difficult to do what I do. Oh, yeah, so you've got to be so. No, it's not rocket science. I was an amateur. Every professional used to be an amateur. I was an amateur in 2004. I didn't have the hedge fund, which is when I turned professional. Okay, I won their competition and proved the point to professionals like Neil Woodford, who came 14th and just above the cat, that they're rubbish. He, in 2004, we already proved was rubbish publicly. You know what the papers did? He's wonderful. They did a massive PR campaign about how he's the golden frickin' boy. His PR company did with his chiseled jaw. And in 2017, after getting billions, had to apologize. And this happens time and time again. You're being shafted because you're not bothering to learn a bit about what the hell's going on. And I think it's worth knowing. And I'm not the only one leading this campaign. That's from over a decade ago in the FT. Underperformance rife amongst active fund managers because they pick from a narrow gene pool like US large cap. Oh, only large cap, only America, right? Or this was a Sunday Times investigation of the amount of money investors paid more than £1 billion in fees over years for funds that did not offer good value for money. Okay. Time and time and time again. But guess what? You'll do it because you see their names and they've got, shiny gold so-and-sos. And so you do it. So what do we do? What I'm going to suggest you do, I'm teaching you to do it yourself. Okay. You do it. Not what do we do? You do it. One of the things we'll do once we've got that list of 10,000 right down to 100 based on value, growth, income. And I'll show you the cash flow criteria, which is probably the most important. The cash flow criteria I'm going to give you is the one which was invented by Deutsche Bank, used by Goldman Sachs Wealth Management for their wealthiest clients. And I stole it. from them at a lunch, which I had with Jim O'Neill, the chairman of Goldman Sachs Asset Management. I was invited as a hedge fund manager to that lunch. And Jim showed me this presentation. I saw that they generate 30% per annum because they follow a cash flow ratio, which their data analyst showed generates 30% per annum. Not every year, not every company, but over the long term, 30% per annum in the basket of stocks which meet that criteria. So I'll share that with you in a second. And so I've added that on. I stole it and added it on. And now I know why those rich buggers at Goldman's, their clients, keep getting richer, other than the other stuff they might do. So I will look at what the gurus own, the billionaires own. You can take a picture of that, but that doesn't mean I buy it. So for instance, yes, we did have last year Chevron come up, and it just so happened Warren Buffett had it, and that's a good tiebreaker. Or Occidental, as many of you'll know, I bought last year around May time, and then Warren Buffett bought it. I thought, oh, okay, well, that means, it makes me a bit more relaxed. But Carl Icahn already had it. That doesn't mean I bought it because he had it. This is really important for you to know. Bill Gates still owns Microsoft, Yasmin. Okay, and Warren Buffett still owns Apple as well. My point is, I'll have a look at these, and you'll sometimes come across this. So I'm trying to teach you how to weigh information that comes your way, because in the modern world, so much data comes your way. And one of the things that you do, and George Soros, by the way, owns Amazon. Okay, Yasmin, as well, and so do I. I'm not bothered it dropped a bit because that was one of my, I'm going to hold for long-term personal reasons, as in, yeah, that's for me. So I just say, if it's a tiebreaker and we've got that list and they happen to own it, well, that'll help us decide, yeah, actually, we'll stay in with that. Okay. Chevron, for instance, and did that hit our criteria? Yeah, it hit our criteria. Is it likely to deliver 40% over the next 12 months? Probably not. Would I buy it today? Probably not. It hasn't made my shortlist, just so you know, of US stocks, just so you know. So even something which is as good as this, I'm willing to walk away. You know, when people win Wimbledon and you go, why is he won Wimbledon, he's retiring? Why would he do that? It's the same with it. Chevron, wow, it's so good for us. And you're walking away? Yeah, because it didn't meet this year's shortlist. The other thing we'll do in looking at what the guru buys are, we'll look at the hedge fund report, see what other hedge fund managers are doing, because we don't have a monopoly on knowledge and insight and all the rest of it. Okay. James will do as well. Eric and Alex, I'll read your questions in a second. They look interesting, actually. AbbVie, right? What's the hedge funds doing? And we found they were very positive. There's a lot of activity, but it already met our value growth, income, cash flow. And that's important for you to know. It met that criteria. And it did this for us. And it's relatively uncorrelated. It's resilient. I'll look at it on a weekly basis, just keep an eye on it. And it's been doing rather well, But did it go up in a straight line? No. And this is also important. People go, oh, Alpesh, God, AbbVie went up for a bit, but then it's dropped. And so, okay. Oh, that's going to, okay. So that was a similar kind of story with this kind of stuff. That, yeah, it's not going to go up in a straight line. But it's got to meet that trajectory and trend line, and we'll look at what the hedge fund says. Would I buy that today? No. That's coming to the end of its period, by the way, if I remember rightly, and I get confused between what's been bought and what's coming to the end. Investing strategy will also, second part, once it's met our value growth incomes, you got the 10,000, remember, got the 10,000, then narrowed it down, filtered it, down to a smaller number. So you got the 10,000 there and filtered to just which ones meet all green. They've got to be all green. How do we do the tie break? Then we might look at discount cash flow as an additional measure and tie break measure of valuation. Catalyst Pharmaceuticals was amazing for this. 69% discount cash flow, undervalued. Now, this is really important for you to understand. We don't start by looking at this. It's not the only criteria we look at. We end by looking at this. Understood? After we've looked at everything else. Okay, because it's not the one and only factor to ever consider. It's not accurate enough to be the one and only factor. If there's one and only factor we could use for anything, oh my God, we'd do it. Why work so hard, right? But there isn't one and only factor. That's why you have to filter. And that's Catalyst Pharmaceuticals. And it's been phenomenal. Will it be phenomenal going forward? Could well be. I can't remember. Did it make my list just now? The US one. I'll have to have another look. I can't remember if it made the list of 37 or not. Okay, but you can see the principle. And similarly with the next one, AbbVie, undervalued. So that was the tiebreaker. Is it sufficiently deeply undervalued? Number 3, leverage on low volatility. I'm not going to go into this, but basically we'll do 2 times leverage max using CFDs or ETFs on companies like McKesson, where that's why that 100% return it generated actually turned out to be a 200%. But don't do leverage. This webinar is not for leverage, and it's high risk strategy to do leverage, and we only ever do 2 times max leverage. That was McKesson, gave us the 100% return since gave us the 50% return since January, which worked out at 100% on the leverage. Okay, analysts also, if they jointly agree as a group that the price has got more than a 40% chance of a return, then yes, that may well be a great that might be a great tiebreaker. It's not, but analysts are rubbish, by the way. That's why it's not an important factor. It's not a big one, but we'll look at that. And you'll see the price there, and that's the average they're expecting. And so they think there's a 47% rise in the price that's possible to get to there. Fine, meets our criteria, and so did the value, growth, income, cash flow as well. The next thing, what do the richest people pick? This is probably the most important slide. You might not realize it. This is the most important slide for me. Why? Well, this is the slide I stole from Goldman Sachs Asset Management, okay, back in the day. And thanks to Lord Jim O'Neill. Quantum database, Goldman Sachs Research, Goldman Sachs Investment Research. What they discovered is companies buy a high CROCI. In other words, cash return on capital invested, cash flow available on compared to the total capital in their business. Those companies in the top quartile, the top 25%, generated a 30% per annum return. 30% per annum return on average. Not every company in the basket, not every year. Okay, as long as they were each year in the top quartile by cash return on capital invested, that basket, which obviously its composition would change each year because it would be based on the companies in the top quartile, generated 30% per annum. So you might say, oh, wow, Alpesh, how'd you get good returns? It's not me. I'm standing on research I stole from Goldman Sachs, and they give to their wealthiest clients. Now, you can get them to do it for you. Just open a private client account for them. I think it's $20 million, and they'll do this for you, okay? Just like in my hedge fund, we've got investors where they're domestic help, basically. We just do the donkey work for them. That's all it is, okay? So I do the donkey work for them, and that's what it is. So each of the companies that I already mentioned, they've got to be in the top quartile. And if they're not, I'll leave them out. And you might say, well, wait a minute, that means you're going to leave out VP, Alpesh. Well, I'd leave all these out because they don't meet the value, growth, income anyway. So none of these get included. See all of these? Because they're not green. The value, growth, income they didn't meet, even if they met the cash flow, even if they met momentum targets. Sortino and Alpha I won't go into in this. It's a bit parochial. Okay, so none of these. Look at the number of companies that don't meet. They've got to be a 7, 8, or 9 based on the value, growth, income. And that means valuation, PE ratios, PEG ratios, revenue growth year on year, and so on. Can I, at the end of this webinar, we're coming to the end anyway, in the last 10 minutes or 5 minutes, I'm going to do the Q&A in a second. Can I just tell you about some technology my hedge fund spun out in terms of the data? We think we're going to revolutionize, so it's a big word, the global fund management industry for the future. We're going to empower more private investors to do it themselves rather than giving it to fund managers every single time. That's what we're doing. The way we're doing it through our little holy grail is making the holy grail of data and investment information there available. But what we've done, which we think is revolutionary, is there's no daily charge, weekly charge, monthly charge. You manage your own money. So there's no management fees. There's no performance fees. There's no data fees, software fees. There's no, as I said, daily, weekly, monthly fees. But what there is not just the data and information, but the one-to-one calls with the fund manager directly, i.e. me. I'm not managing your money. You're managing your own, so that you can learn and you can see one-to-one calls. And we thought, this is, with technology today as it is, modern technology, this is something which could be worth billions, because we think people want it. Because, well, 90% of you on this webinar say, no, Alpesh, we'll just do it ourselves. Thank you very much. And that's perfectly fine. But if you do it yourself, please make sure you look at value, growth, income, cash flow, momentum for that reason. Okay, please look at those factors. Okay, if you don't want to do it yourself and you want all the data and software and you don't want to pay for it, because the whole point of what I've said about fund managers is they're charging you fees. And you want to be in charge of your money with whichever broker you're with, whichever manager you're with. You make the decisions, but you've got the tools with which to do it and the calls. And we actually put we train people in my hedge fund. When we train them, we realize if we make that training material available and put it into basic language for beginners or pensioners, then they can be educated themselves. So we put that into a little course material. I'd created the course because I was the CEO of the firm. And one lady has gone on to manage 10 billion at Polar Capital, and she was at Newton. And we've had another lady who is now global head of communications at Wells Fargo Bank. So they learn enough about finance from me, okay, and put it all in. By the way, this is why I say 15. After that, you're really not diversifying away. 15 to 40 max stocks. Once you have more than 40, we found most private investors can't manage it. And what we do with clients is we take their existing portfolio and talk them through it, do the analysis for them, and then on a Zoom call, talk them through it and say, right, this is the risk levels and so on. And then say to them, these meet the criteria you want. You decide whether you want to pick them or not, because you've got to decide your risk appetite. And you might say, yeah, okay, yeah, I think I will, as opposed to a fund manager who just decides, yeah, I'm going to go all in because I've got to earn my fees, and the market falls and you're screwed. That's not right. Somebody else should not be managing and be in control of your capital, I don't think, or if they are, you should at least be able to keep an eye on them, and that needs education. That's what we're about. Naomi joined me as my assistant straight out of university at the age of 21. She worked for me for 2 years. Whenever she launches a new fund within Polar Capital now, that's when she was at Newton, she manages billions. She always mentions her 2 years at my firm, for which I'm honored and pleased, not least because there aren't many women in asset management. I can teach anyone. She's an English language graduate. I can teach anyone to become a multi-billion-dollar managing fund manager, and certainly anybody managing less than that. And that's the point. The reason we did this out of the hedge fund is we felt if we take the technology out, we've got potentially $1 billion business, because if you can get enough people using it, you've got valuations, which, as you know, venture capitalists will pay millions into, because you're disrupting the asset management industry. You're getting people empowered to do it themselves, but you're not charging them anything every day, every week, every month, every year. So that's why we did it. And also because we get a lot of people who are pensioners saying, I don't trust my IFA. I need education to know what to do. I need the data at my hand so I know what to look for, or I want it done for me, or I want to learn, but I want to have calls with you. I want a second opinion, somebody to look over what we're doing. I started finessing the investment approach when I was at university, perfected the strategy, won competition in the FT. They asked me to write books, which raised my profile so I could set up the asset management company in 2004. Okay. People asked me to do this initially for years, and I said no. Then technology came along and it made it possible. And that's why I'm the one on the webinar, because a bit like when Steve Jobs launched the iPhone, he's the one doing the presentation, or Steve Ballmer when he was head of Microsoft. This way, you get the calls, you get the convenience, get a regulated fund manager, no travel, hotel costs, it's broker independent, you get that information, ongoing support, lifetime updates, weekly market updates, daily updates on my Telegram channel, the private channel for clients, where you can see what I'm thinking about the markets, but you don't need to look at it daily. Once you've picked the portfolio for 12 months, you're pretty much okay. When I'm on TV, that's what I use. That's what I use when I'm on TV. And the other reason we decided to do that is because of this. That's so much positive information, positive reviews from BBC, Merrill Lynch, American Express, Hedge Fund Managers, Financial Times, Coots. I thought, you know what? There's nobody else out there who's anywhere near doing this, and we should do it. Then we tested it with a bunch of clients, and every single one of them, outstanding. We did video interviews with them so people knew, okay, these are real people, not just actors or quotes or whatever. And did the reviews, and they're on the website as well. And the way we do it is through Zoom, Skype, Telegram, which are all the ways people are used to, individually, one-to-one with people, and give them access to the materials so that they can learn if they wish. But more importantly, most of them, they just want to do this. They just want to see my portfolio. They want the data every month. They want to have the one-to-one calls. They don't actually want to, and these are some of the returns from some of the stocks, they don't actually want to go through the educational stuff, which I wish they would. We call it the Great Investments Program. And we think it ticks every single box, which fund managers don't, IFAs don't, DIY doesn't, doing it itself doesn't, and robo-advisors certainly don't. We think it ticks every single box there, particularly the lifetime one-to-one holding. And my plan is to get venture capital investment into it, and then eventually, this is the materials if you want to learn. Most people don't want to learn; they just want the data and they want the calls. Okay, they want the data and the calls. They don't want to learn through all of this. But you know, we've put together in the newsletters and all of this for them if they want to, and some of them do. Some of them want to be fund managers. Some do it for their kids, and so on. But that's all in there, and it's all part and parcel of it, and it's updated on a weekly basis there as well. We're making that available in groups of 10 at a time because I'm the one who's onboarding, and it's yours for life. It's yours for life. Okay. And then we thought, well, how do you price something like that? And we spun it out of the hedge fund because we thought, if you get some technology, we're used to, as a business, investing in other people's companies. And we thought, well, why don't we spin out our own? Because tech companies are getting crazy billion-dollar valuations. This isn't how much it costs. This is what we estimated the values are of all the things that we're giving. And some of you might value things more than others. But like I said, for most people, what they're really interested in one-to-one calls and the access to my database and my portfolio and knowing when I bought something. So when I buy something off that list, I gave you that short list, and the full list will go to the client. I'll post that on the Telegram and say, okay, I've decided to purchase that on this basis. Way we look at the return on investment was this. If somebody makes a 20% return on a 500K ISA in a year, maybe in 2 years, or maybe just over a number of years, they make a 20% improvement on their returns. They've got an extra 100K in their pocket, an extra 100K. Obviously, not every year will be a 55% return. Lifetime updates, no ongoing fees, and you can see the reviews on there. That's where you go to if you'd want to get us to do it for you. Okay, we think that using that technology, being access to all that data, which also, by the way, includes things like the Dow, the NASDAQ, the FTSE 100, FTSE 250, and it's got to be all green. So we actually talk through your own portfolio and your risk, so you make the decisions. And exchange traded funds, which ones meet the criteria based on your risk profile. So each person's risk profile has to be individualized. So we work out what your risk profile is and then say to you, right, that's the short list. And then you pick them and we say, no, you've got that wrong, which is what sometimes happens. Or yes, that makes sense. Now watch out for this and do this. So you're totally empowered and you don't have a fund manager taking the capital away from that. I'm going to go, that's where you go. You go to alpeshpatel.com/shares if you'd like to sign up. There is a discount code. It's OCT6 for the webinar. On webinars, I do a discount. And the reason I give a discount on the webinars is because I only do the webinars if I know I've got a period of time where I can take on more people and onboard them as well. And you can also do it just as installments if you wish. Okay, and it's on there. And in the first 7 days, we'll have 2 calls. The first call where you send me your portfolio if you've got one at the moment, and we'll go through it and we'll get you on board and have a look at all of this. And then in the second call, we'll analyze the short list of what would be appropriate for you in the right mix of stocks and so on. What we also share on here is not just the billionaire portfolios, but also if there's any analysts who have been getting over 40% per annum, then we'll look at what do they own at that time and share that data with you. We don't really put too much weight on it because that's usually from their last set of filings, which usually means it's 2 or 3 months old. So I don't really care about that. It's more, oh, okay, they own something we do. That's interesting. And they're usually getting 67% returns. We'd also share the Goldman Sachs material in terms of asset allocation, how much should be in fixed income, how much should be in equities as a result of that. Okay. Ask me any other questions, either on this or anything that I've covered. So if you want us to do it for you and do all the data and provide the handholding, usually it's business owners or professionals who are time rich, cash poor, people who are retired and want to look over. Thank you. There's several of you coming on. As you come on, let me know and I'll give you a shout out. Any other questions as well, let me know. When you go, oh, by the way, and do connect with me and follow me on LinkedIn, all of you. If you've signed up, then connect with me. If you've not signed up, then just follow me on there because only clients I'm taking on to connect with me. And I do physical events as well. And I want to make sure I meet all the clients as well. When you go to the website, alpeshpatel.com/shares2, that's where you put the coupon. Please put the coupon code in so that it takes off £10,000 basically, or there's installments and it will take off the amount there as well. So you can do it over 8 months and get immediate access as well. Our eventual plan is to get venture capital investment into this entity, into what we're providing, and that by that stage there'll be other mentors for the students globally, because we've already got ones from America, Australia, as well as obviously the UK, New Zealand, Singapore, Hong Kong, and the Middle East. You will always have me, and the fees won't change for you. Eventually, the rates will go up because it's a one-off, and it'll probably become more a subscription model, but that won't impact you guys. Those who come in the first 1,000, they're the charter members, and I'm taking them on in groups of 10. Sorry, the first 250, not first 1,000, first 250, and I take them in groups of 10. That'll never change, and I'll always be your original charter member mentor in that, so that won't change. Sash, the links. Sash, do you remember I emailed you after the last webinar and I sent you the links? It's on the links. I sent you the links, but I'll do it for everybody as well. Sash, I'll send you the links as well in just 1 second. Let me send you the, for everyone can see it on the screen. Okay. I'll send you the link to, let me first send you the link to this, the program, and then I'll also put in the link to in a second, so people don't get confused, the link to the research reports and the link to Telegram and all the rest of it. There's 2 Telegram channels. There's a private channel for clients, which will show you what I'm buying when I'm buying it, and there's the public one, which Sash, you're not a client, you'll be on the public one, which will just tell you more broader what I'm looking at in the markets and so on and so forth as well. Okay, so that's the more broader one on there. I've got another question. Where are we? Alex, you've got your Hargreaves. I'm 24 years old. Would like some help with stocks to invest. Yeah, well, you're on the webinar, Alex, so that's the starting point. Eric, sincerely, Croaky criteria good. Excellent. Consensus target still okay. Should I still find? Oh, Eric, you'll have to email me on that more detail. I don't know which stocks you're talking about. It's difficult to judge just blind. You've just said I've got some stocks which have gone up. Should I keep hold of them? It's impossible to judge. I don't even know what the names are of those, so I'd need to know that as well on there. Oh, I wanted to show you what I like to do at the end of the webinars is also go through the slides just so that we reiterate, like at the end of a class, 15 to 40 stocks. Okay, please make sure you look at value, growth, income, ideally some measure of cash flow. Croaky you won't be able to get in most places, so a measure of cash flow. Momentum, i.e. something that's gone up at least in the last 6 months. Sortino and Alpha we've not really covered in this webinar. Don't worry so much about those two. But if you do get the time, they should be positive. That's why cash flow. Analyst is a tiebreaker. Okay, I want to see, will it go over 40%? I think you should have a benchmark, a hurdle rate. And if you don't think it's realistically possible, then it shouldn't be in your portfolio. Okay. Tiebreaker is also discount cash flow, severely undervalued. Right, that's what we want. We happen to look at hedge fund reports as well and billionaires to see what they happen to own. But far more important to us is the fact that we're not paying away fees to any third party. Okay, and that's the returns we're after. Whoops, that's the returns we're after. Obviously, some years, the years in which you get a bumper return, do not think you're going to keep getting that every year. You save that for the years in which you won't be. Nathania, 401k managed by Vanguard. Yep, with that employer match. Utilize donating funds towards the strategy instead. Nathania, I should email you on that in more detail because it just depends what they're doing for you, and you should be the one making the decision. Curran, I am. Yeah, I'm happy to, Curran. I'll leave a space for you. Don't worry, I'll email you after this and make sure. Thank you, Paris, as well. So Nathania, I'll email you on that. Personally, the problem I have with Vanguard is not that they're ever going to steal your money. They're not. What's going to happen is they're a closed-end shop, so they only recommend their own funds. And if you look at their own funds, they've not been performing rather well over the last 12 months. Well, neither has the market. But they haven't opened it up to everyone else. And the other problem you'll have with Vanguard is, and if you send me, say, just even one of your Vanguard funds that you're invested in, you'll notice they've got about 50 to 100 stocks they've invested in. So you might think you're getting into a really good company, Like, for instance, let's say you did want to be in Generac and they've got it and you think, oh, I'm in it. Well, actually, they'll have 0.1% of their capital there. So, I mean, the short answer, Nathaniel, is yes. I'd say divert to there. I'm sorry, but I'd say yeah. I certainly would. And I can tell exactly. I can tell you what they've been doing, and they'll also, and you'll be wondering, wait a minute, everybody knew the market was going to be falling by around March, April time. It just became clear. In January, if you were visionary, you thought it. I didn't think it in last January, but by next February, I thought, no, I've got to wait. Because in January, I thought I've got to wait till February. And then February, I thought, I've got to wait till March. March, I thought I've got to wait till April. And then the whole year started going like that. So how come they kept you fully invested? How come they didn't hold more cash? How come they just kept holding stocks which kept falling? Those are the things to ask. When we in May started buying more energy stocks and then healthcare stocks, how come they weren't? Or if they were, how come they were buying too few of them? Well, because the fund managers and the funds they were in weren't allowed to buy energy or healthcare stocks, which is where the market was going and everybody knew it was going, because they were, let's say, in, I don't know, consumer only, and they're only allowed to buy in that narrow gene pool, and they keep doing this, and they keep charging the 2% or 1% or whatever it is. They say 1%. It is 10% over 5 years. Because there's all sorts of other hidden costs. And another investigation by the Times showed that actually what happens is they're working out their costs wrong. So it is a lot more than a lot of these companies say. I'm not saying Vanguard are working out their costs wrong, but there were quite a few that were mentioned that were. And I just showed you that other one, which was from a fund. That pink thing was from a fund called 91. And 91 was one of the fund managers, which were charging 10% over 5 years, but they call it 1% charge fees. Well, actually, no, that's what it worked out at. So Hikma is one of the ones which has made my list. I'm going to finalize all the rest of them and I'll send them to the clients who are on the program during the course of this week. What I will also do is, so Cambion, I'm almost certainly going to be buying. This is from the US. The clients who are on the Great Investments Program, you'll get the full unredacted list, and I'll probably send that to you tonight. And I'll also keep updating you on which ones I'm buying into as I do it. I'm not necessarily going to buy all 37 in one go, just because I'm still a bit nervous about the markets. And some of these will get filtered a bit lower as well. They will get reduced. They will get, so some of them might not make the very final list into my portfolio. But whichever ones do, I will tell you on Telegram to the Great Investments Program clients. But this is the list as it stands from yesterday, from 10,000 to 100. Down to 37. Every month, I also send my clients from the main list, which is updated on a monthly basis, from the database, which is updated every month that they have access to. What I also send them every month is also the top 100 in a PowerPoint, so they can see their valuations, they can see all the other information, and then an update for them as well on that. Okay, so they get all of that as well. If there's no other questions, for everybody who signed up, thank you very much. Anybody who needs me to hold a place, please let me know before they go. I think there's 2 left. So I want to thank everybody who has already. Yanis, thank you to you. Carlos, thank you to you. Del, thank you to you for signing up as well. Raymond, thank you to you for signing up. Let me see who else I've got on here that I can see. Amritaj, I should be able to pronounce that better. Amritaj, thank you for signing up. And Vic, thank you for signing up as well. I think I've given a shout out to everybody as well on there. If there's no other questions, I will jump off. All the ones who are on the program already, you're going to get the unredacted list and also on the private Telegram channel, which ones I'm getting into after the webinar as well. And you'll get the UK list as soon as I finalized it. For everybody else, the UK list, I'll probably do another webinar once I finalized it. And I might try and get that done to about all-nighter yesterday, just to get these done. And of course, every month, that's all updated anyway. So Jacob, I'll hold a place for you. Not a problem. I will hold a place for you. How long do you need me to hold it for? Let me know. Alex, Alpesh, my company pension has to be in a fund. Yes, it is currently with Bluewell Global Grow. And it's your opinion of this fund. I'll look it up. I'll look them up. Yeah, company pensions do have to be oftentimes with that. And sometimes what you could find out is how much are you allowed to add to your SIP? I mean, if all of your monthly annual allowance of 40,000 is going straight into a company fund, then you'll have nothing left over except for your ISA. So you'll still be able to take this approach with your ISA, because that's 20,000, and your wife's ISA and your child's junior ISA. So there could still be about 50 grand a year you're deploying in ISA money. But also you'll be able to look over the shoulder of other fund managers with the knowledge behind this. So sometimes you've got people who are not necessarily picking their own stocks. They're just sending what that fund manager's done. And feel free to send me the documentation of the stocks that they've own, because they'll have to tell you that. And we can look through them and say to you, well, look, this is just so you know what's going on. They've got these companies which are overvalued, low growth, and they seem to be speculating on direction. Or I might say, oh, wow, yeah, they've got some really good ones we've got, which will probably be the case. They'll have a few good ones, but just not enough. That's usually the problem. They'll have a few good ones, but just not enough. And then you get fund managers blowing up. And as you've seen earlier, it only takes a small percentage change for it really to mess up your entire pension growth. Okay, because what happens is that 20% or 19% or 18%, a little deviation, you're missing out on 100K in 10 years. You know, but the reason the fund management industry works is because you'll never know you've missed out on it. Anyway, we're very much more targeted than that because it's bespoke. So it's, Alex, do these look like they're going to hit the 40% per annum? It's very much more bespoke, as opposed to, let's take Alex's money, a million other people. You'll never have spoken to your fund manager. The guy who's running your pension, you've never even spoken to. You probably don't even know his name. You know the salesman's name, but you won't know his name. I think that's atrocious. That people don't even speak to them. You know, I used to be on the investment committee at Chatham House, whose patron was Her Majesty the Queen and is now His Majesty the King. So our job was serious. And on the investment committee, we would get Cazenove and all these funds coming to us. And you know who'd come present to us? It was never the fund manager. I'm thinking, do you know who we are? And it wasn't ever the fund manager. They're too important to be, you know, they're all sitting in wherever they're sitting to come. I think that's atrocious. And I said on the investment committee, I said time and again, right, we move the money to exchange traded funds. We just manage it ourselves effectively and sack the fund managers. But most people are too afraid to do that, and that's fine, because what you can then at least do is keep an eye on the fund manager and say, well, what's happening? What's going on? Why isn't it in this? And have some of your ISA money in there. And that I think is a good complement to what you've got in the SIP, which might be managed by somebody else or in your pension, is at least your ISA funds can be managed by you, and they're tax-free, don't forget, as well. So that growth that we looked at, that's tax-free in ISAs. And your ISA might be with Barclays. It could be with, I just saw an advert today, Interactive Brokers are now doing UK ISAs as well. Everybody's getting in the market on that as well. Just going through the slides and see if there's anything that I missed. So to get access to that, that's the links to all of that, and I'll email, some of you have messaged, I'll email you afterwards anyway. So I'll send you the links, all links. Okay, I'm just going to put it as a message on the chat box. alpeshpatel. So you've all got it. Links. There you go. So that's the links page. You should be able to have got a message, all of you, so you can download all of this for free. Okay, all of these reports, if you want to have a look at them in more detail, and a lot more besides. So we covered all of that. Just want to make sure I've covered absolutely everything. If there's any questions I've left unanswered, please let me know. Please let me know if there's anything I've left unanswered at all. Otherwise, I'll jump off, because I've kept you now over 2 hours, over 1 hour, and I promised I'd try and end it in an hour on the webinar. So thank you all for being on board. Thank you all the people who've signed up. I am about to, and Jacob, I'm holding a space for you. I'm about to email you all, and we'll onboard and get that first call in the calendar. It might even be today if you've got the time. Otherwise, we'll do it on Monday and get you on board and get you access to all the data that we've got. Go through your portfolio if you've already got one, and if you haven't, we'll get talking. And some of you might only have as little as 10, 20,000 in your portfolio, because you're going to end up having more. Others, we've got clients with 20 million, 30 million, because they've sold their businesses and they want to manage the capital, or they give some to the fund manager, and some they're just keeping managing themselves as well. But whichever way it is to educate and empower you, so you've got the tools to do it efficiently, effectively, and then that is your side business, is managing your capital. In the case of some, others are doctors, medics, lawyers, And in their case, it's just that they're time poor and cash rich, and they just need somebody to occasionally have a call with and say, right, this is what I've picked. I've got to hold it for 12 months. And because you're not trading it, you're holding it, it makes life a heck of a lot easier as well. Okay, thank you all very much. I think that's everything and everybody covered. The rest of you, 1 or 2 questions I'll answer in depth after the webinar because they were more detailed. So I'll make sure I do that, like for you, Karen, as well. Okay, thank you all. I hope you enjoyed the webinar. I hope you found it educational and informative. Please let me know in the chat box if there's anything I can do to make it even better next time, if there's anything more you want covered, if there's anything you feel I still missed, and I'll email you directly afterwards as well to take care of all of that. Okay, thank you all very, very much.